Imagine finding a hidden trapdoor in your business's finances, one that, if left untouched, could be quietly costing you significant money year after year. For countless business owners, that trapdoor is nestled right within the often overlooked nuances of partnership and LLC taxation. But what if I told you that understanding just a few key principles could not only seal off those costly leaks, but also unlock powerful tax savings you didn't even know were possible? We're about to open that trapdoor. Welcome to the Deep Dive, where we take complex financial sources and distill them into actionable, wealth-building insights just for you. Today, we're cutting through the jargon, not just to understand how partnerships and limited liability companies or LLCs are taxed, but maybe more importantly, how you can leverage that knowledge for significant tax efficiency.
Yeah, our mission today is precisely that, to demystify these powerful business structures. We want to move beyond just the mechanics, and truly focus on exactly how income and expenses flow through to you, the individual business owner. We're going to expose some common missteps that cost real money and, crucially, highlight specific strategies embedded right within the tax code, strategies that can lead to substantial savings, ensuring you're not leaving a single dollar on the table. So let's start right at the core, right? With the fundamental advantage that partnerships and LLCs offer, this flow-through design. This concept is really the bedrock of their tax efficiency. At its essence, a flow-through entity means that the business income is taxed only once. This happens because the income literally flows through directly to the individual partners or members. So it's you, the individual partners or LLC members, who pay tax on that business income. The partnership or LLC itself, it doesn't pay income taxes.
Okay, so that's the critical distinction. It bypasses that corporate level tax.
Exactly. It's a very important contrast to traditional corporations, especially C corporations. With a C corp, income can be taxed first at the corporate level, right? And then if and when that income is distributed to shareholders as dividends, it gets taxed a second time on their personal returns. That's what we call double taxation. Flow through avoids that.
So effectively, the business is just a conduit then, ensuring income is taxed efficiently at the individual level. Sounds like a fantastic way to avoid that corporate tax hurdle. But okay, if the partnership isn't actually paying taxes itself, how does the IRS keep track of everything? What's the blueprint for all this financial activity? I know Form 65 is involved and Schedule K1. Can you kind of unpack how those pieces fit together? Like, what's the roadmap?
Roadmap, that's a perfect way to put it. So Form 1065, that's the main partnership return filed with the IRS. But it's crucial to remember, it's just an informational return. It's not a tax payment form for the partnership itself. It's essentially an annual report detailing all the partnership's income, all its expenses,
Yeah.
giving the IRS a complete snapshot of the business's financial activity for the year. But the real action, and honestly where a lot of confusion or, strategic opportunity lies, is in the accompanying documents. Schedule K, and particularly the Schedule K1.
The K1. That's the personalized roadmap for my slice of the business's financial picture, right?
Precisely. Schedule K is like a summary for the whole partnership, showing all the different types of income, gains, losses, deductions, all in one place. Then the Schedule K1. That's the personalized version of Schedule K, created for each individual partner. This document communicates your specific distributive share, your slice of the pie of all those income, gain, loss, and deduction items directly to your individual tax return, your Form 1040. And this is incredibly important because partners are liable for taxes on their share of the income, as reported on that K1, regardless of whether they actually received a cash distribution from the partnership.
Wait, regardless. So even if I didn't get the cash in hand.
Exactly. You might not have physically seen the money, maybe it was reinvested in the business, but if it's on your K1 as income allocated to you, you're on the hook for the taxes on it. So, the ultimate insight here is that this foundational flow-through characteristic is the primary tax benefit. It inherently avoids that double taxation associated with C corporations. Understanding the structure, really getting it, is the first step to leveraging its power. That distinction is absolutely crucial. Now that we understand what flows through, let's break down how those different types of income and expenses are treated, because that's where the next layer of complexity and, frankly, significant opportunity lies. We're navigating the grand breakdown, partnership income, expenses, and what we call separately stated items. This distinction is critical for accurate reporting and, maybe even more importantly, for maximizing deductions. You see, the ordinary business income or loss, that's what's left after all the regular day-to-day business expenses are accounted for.
Right, like salaries, rent, the usual stuff.
Exactly. Gross business income minus salary expense, rent expense, depreciation, the typical operations. But then there are these separately stated items. These are items that retain their specific character. They're treated individually on your partner tax return because they have different tax rules or implications attached to them. For example, capital gains are taxed differently than ordinary income, right? Or certain deductions might have specific limitations only applicable at the individual level.
Yeah.
Misclassifications here, like we'll see in some examples later, can lead to costly missed tax opportunities or even incorrect tax liabilities.
Got it. So it's not just about adding up the numbers, it's about putting them in the right buckets. You want to make sure you're not leaving any tax savings locked behind the wrong door. Okay, let's really drill down into some of those key pass-through items. What's the first bucket?
The primary bucket, the main one, is your ordinary business income and expenses. These are your core operational figures. We're talking about the gross income your business generates from its main activities, minus the regular expenses you incur to run it, like salaries paid to employees, the rent for your office space, or the depreciation on your equipment. These directly contribute to the ordinary business income or loss calculation on Form 1065, page 1. It's the profit or loss from the day-to-day grind.
Okay, makes sense. Now, what about when the partnership have income from something like real estate? That often has different rules, doesn't it?
It absolutely does. Net rental real estate income or loss is a classic example of why separate statements are so important. If a partnership owns rental property, that income or loss isn't just lumped in with the ordinary business income. No way. It's separately stated because it's frequently subject to specific passive activity rules on a partner's personal return. This means there might be limitations on how much of a rental loss a partner can actually deduct in a given year, especially if they're not actively involved, materially participating in the rental activity. Misclassifying this, it can directly impact a partner's ability to use those losses, potentially suspending them for years.
Yeah.
It's a common area where businesses, well, they miss out on current deductions.
Okay, passive activity rules. That's a key flag. And what if the partnership earns money from investments, say interest and dividend income?
Those are also separately stated. They flow through to the partner and are treated as investment income. So they're subject to their individual investment income tax rules, not the ordinary business income rates. This can be crucial for partners who might have investment interest expense deductions because these incomes provide the necessary net investment income ceiling against which they can deduct that expense.
Right, and capital gains and losses. Given their unique tax treatment, I imagine those would be separate as well. Without a doubt. Long-term, short-term, they are passed through to partners and are subject to individual capital gains rules, which, as you know, can vary significantly from ordinary income rates. Often much lower rates for long-term gains. This is a critical distinction for tax planning. Similarly, net Section 1231 gain loss. This comes from the sale of certain business property like your office building, machinery, or equipment that's been held for over a year. That's also passed through separately. The beauty of Section 1231 gains is that they can receive that favorable long-term capital gains treatment. That's a powerful tax benefit for the partner. But interestingly, Section 1231 losses are typically treated as ordinary losses, which is also generally beneficial because ordinary losses can offset ordinary income without the limitations of capital losses. So getting this right really helps maximize favorable tax treatment on both gains and losses.
It really sounds like a lot of these separate items are all about ensuring the right tax rate or the right deduction treatment ends up on the partner's individual return. What about giving back? Say the business makes charitable contributions. How does that work? Good question. Charitable contributions made by the partnership itself are passed through to the partners. The partners then deduct these contributions on their individual returns, Schedule A usually, subject to their own adjusted gross income or AGI limits. So the partnership facilitates the deduction, reports it on the K-1, but the individual partner actually claims it within their own tax framework. This allows the partners to maximize their charitable deduction based on their specific individual tax situation.
Okay, and there's a big one I've mentioned a lot, especially for businesses buying equipment. They can provide an immediate tax benefit. Section 179, expense deduction.
Oh, Section 179 is absolutely a powerful tool, especially for cash flow and immediate tax savings. It allows businesses to elect to immediately expense the cost of certain depreciable assets, think equipment, machinery, certain software in the year they are placed in service. Instead of deducting them slowly over many years through depreciation, you get the deduction now. This immediate deduction is passed directly to the partners via the K-1, providing a significant upfront tax benefit and reducing current taxable income. Now, there are limitations both at the partnership level and, importantly, at the individual partner level based on their business income. But for many businesses, maximizing this deduction can really slash their current year tax bill.
What about expenses related to investments the partnership makes? Like if they borrow money to buy stocks or bonds, what about the interest on that loan?
Right, investment interest expense. That's another separately stated item. This interest expense is deductible by partners, but only up to the amount of their net investment income. It's a very specific rule, and again, if this isn't separately stated on the K-1, a partner might miss out on a legitimate deduction, or, maybe worse, miscalculate its limit and deduct too much, leading to problems later.
And for the partners themselves, what about their health insurance premiums? Is that treated like a regular employee expense?
That's a common point of confusion, actually. Partners' health insurance premiums are generally treated differently than employee health insurance. For partners, these premiums are often included as part of what we call guaranteed payments, which we'll unpack in a moment. They are then deductible by the partner on their personal tax return, specifically as a self-employed health insurance deduction. It's an above-the-line deduction, which is good. It's not typically treated as a direct business expense of the partnership reducing ordinary income on Form 1065, page 1. This impacts where and how the deduction is taken, and it's important to get it right for the partner to get the benefit.
Okay, interesting distinction. And retirement plan contributions, it sounds like there's a similar distinction there too, between employees and partners.
There absolutely is a critical distinction. Retirement plan contributions for employees. Pretty straightforward. Those are business expenses for the partnership, directly reducing ordinary business income. However, retirement plan contributions for partners are treated quite differently. They aren't usually a direct business expense reducing ordinary income on page 1 of Form 1065. Instead, they're often tied into the partner's self-employment income or their guaranteed payments, and they impact the partner's personal deductions for those contributions on their 1040. It's a nuance that can easily lead to miscalculations if not handled carefully, potentially costing partners significant personal deductions for things like SEP IRAs or simple IRAs.
Got it. Finally, what about tax credits? Do those flow through as well, like energy credits or R&D credits?
Yes, absolutely. Tax credits generated by the partnership, like the research and development credit or various energy credits, are reported by the partnership but are claimed directly by the individual partners on their returns. They flow through on the K-1, retaining their specific character, so the partner can apply them directly against their specific tax liability. And remember, credits are often more valuable than deductions because they reduce your tax dollar for dollar, not just your taxable income. So the powerful insight here, the main takeaway, is that understanding which items are ordinary and which are separately stated is truly crucial. It's not just for accurate reporting, which is important, of course, but really for maximizing deductions and applying the correct tax rates at the partner level. As we'll see in some diagnostic examples from tax software, simple misclassifications can lead to significant mistax opportunities or incorrect tax liabilities down the line. Every item has its place in its own set of rules, and getting them right is a direct pathway to substantial tax savings and, staying compliant.
That makes perfect sense. These buckets really matter. Okay, now let's talk about a powerful tool for partner compensation that's also, importantly, a direct tax deduction for the business. Guaranteed payments. What exactly are they and why are they called guaranteed?
Okay, guaranteed payments. They're essentially compensation paid to a partner for services they provide to the partnership or sometimes for the use of their capital. The crucial distinction, the reason they're called guaranteed, is that they are paid without regard to the partner's profit or loss sharing ratio. This is key. They're not dependent on the partnership hitting a certain profit target for the year. They are fixed payments determined beforehand. Much like a salary you might pay an employee, but this is specifically for a partner acting in a capacity other than as a partner or for the use of their capital.
Okay, so they're guaranteed fixed amounts. But how does that translate into tax treatment? Seems like they have this kind of dual role.
Yeah.
A direct deduction for the partnership, which is great for the business's bottom line, but then also taxable income for the partner. It feels almost a little too good to be true. Is there a catch?
It's a clever mechanism, definitely, and you've hit on their unique dual nature. For the partnership, guaranteed payments are an allowable tax deduction. They directly reduce the partnership's ordinary business income on Form 1065. This is a key benefit for the partnership entity itself because it directly lowers the amount of taxable income that then flows through to all the partners based on their regular profit shares. It's a very direct way to manage the taxable income of the partnership.
Okay, deduction for the partnership. Got it.
However, for the partner receiving those guaranteed payments, they are included on their Schedule K-1 and are considered ordinary income, just like salary income would be. They are also almost always included as part of net earnings from self-employment, which impacts the partner's self-employment tax obligations, for Social Security and Medicare. Now, here's a very important note, and it's a common area of confusion or sometimes missed planning opportunities. Guaranteed payments for services are not included in qualified business income or QBI for the Section 199A QBI deduction purposes.
Ah, okay. That's the catch, maybe. So it doesn't count towards that 20% deduction.
Yeah, exactly. While they're a deduction for the partnership and income for the partner, they don't count towards that potentially lucrative 20% QBI deduction for the receiving partner. This is a significant detail when you're planning for overall tax efficiency. It affects the partner's bottom line differently than their share of the regular partnership income would.
Let's walk through an example to make this clear. Let's use the Acme partnership. They had a gross business income of $250,000 for the year. They also had salary expenses for non-partner employees of $50,000, rent expenses of $15,000, and depreciation of $10,000. And importantly, they made guaranteed payments to partners totaling $35,000. So given these figures, how do we correctly calculate the partnership's ordinary business income? Where do those guaranteed payments actually factor in?
Okay, let's unpack this calculation step by step, focusing on how each item hits the bottom line for the partnership. We start with the gross business income, $250,000. From that, we subtract the ordinary business expenses. So first, the employee salary expense of $50,000 comes out. Then, critically, the guaranteed payments of $35,000 are also subtracted right here as a direct deduction against ordinary income, just like the salaries or rent. Then we subtract the rent expense of $15,000, and finally, the depreciation expense of $10,000.
Okay, so let me run those numbers. 250 minus 50,
Yeah.
minus 35, minus 15, minus 10.
Right, so $250,000 minus $50,000 is $200,000. Minus $35,000 is $165,000. Minus $15,000 is $150,000, and minus $10,000 in depreciation leaves you with $140,000. That $140,000 is the partnership's ordinary business income that will then be allocated to the partners on their K-1s based on their profit-sharing percentages.
So those $35,000 in guaranteed payments are a direct reduction right there on page 1 of the 1065, which immediately reduces the partnership's taxable income before it even flows through to the partners. It seems like a very direct and transparent way to compensate partners while immediately reducing the business's overall taxable income.
Absolutely. This is why guaranteed payments offer excellent flexibility. You can compensate partners for specific roles or contributions, provide them with a steady income stream, and get a direct entity-level deduction. It effectively manages the flow of taxable income that ultimately lands on the partner's individual returns. But as I mentioned, that exclusion from QBI and the impact on self-employment earnings means careful planning is essential. You need to look at the whole picture. It's not just a simple deduction. It has ripple effects across the partner's entire tax situation. It's a very specific lever that needs to be understood fully to be used effectively for tax savings.
Moving on from ongoing expenses and compensation, let's talk about getting a smart start for your new business. When you're setting up a partnership, or LLC, there are always a bunch of initial costs, right? Legal fees, filings, getting things ready. What's the tax break here for organizational expenditures and startup costs? It feels like a potential early win for a new venture.
It absolutely is an early win, and one that new businesses, in the rush of getting started, sometimes overlook or mismanage. It's a great early-stage tax-saving opportunity. The rule is this. A partnership, or an LLC treated as a partnership, can elect to deduct up to $5,000 each of organizational expenditures and startup costs in the very first year the business begins active operations, so potentially up to $10,000 in immediate deductions right off the bat.
Okay, $5,000 for each category. Is there a limit?
Yes, there's an important phase-out. This $5,000 immediate deduction amount for each category is reduced, dollar for dollar, by the amount that the total costs in that category exceed $50,000. So, for example, if your organizational costs were, say, $53,000, you'd lose $3,000 of the immediate deduction, 50K or 3K excess. So your immediate deduction would shrink from $5,000 down to $2,000. Any costs that aren't immediately deductible, either because they exceed the initial $5,000 or because of this phase-out rule, are then amortized. That means they're deducted slowly over time, specifically over 180 months, which is 15 years, beginning when the business actually starts operating.
Got it. 15 years is a long time compared to getting $5,000 right away. So what exactly qualifies for these deductions? What kind of costs are we talking about for a new business?
Good question. The definitions are specific. For organizational expenditures, we're looking at costs directly related to formally creating the partnership or LLC entity itself. This includes things like fees paid for legal services, specifically for drafting the partnership agreement or operating agreement. Also, fees for accounting services related to setting up the partnership's initial books and structure, and any fees paid for partnership filings with the state, like filing your articles of organization or certificate of formation. These are the direct one-time costs of formally organizing the entity.
Okay, legal, accounting, filing fees for setup. What about startup costs?
Startup costs are a bit broader. These are generally expenses incurred before the business officially opens its doors and begins generating revenue, costs that would normally be deductible if the business were operating. This includes things like training costs for your initial employees before opening day, advertising costs to get the word out before launching your product or service, market research to test your business concept, or even travel expenses related to securing suppliers or initial clients before you're actually open for business.
And what absolutely does not qualify for these immediate deductions or even the amortization? Is there anything specifically excluded?
Yes, a key exclusion here is syndication costs. These are costs related to marketing and selling interests in the partnership itself. Think about preparing offering materials, investor prospectuses, legal fees specifically for raising capital from investors. Those are specifically deemed non-deductible and cannot be amortized either. The IRS views these as costs to acquire capital, not costs to start or operate the business. So the powerful tax-saving insight here is really critical for new partnerships and LLCs. Properly categorizing these initial costs and making the election to deduct them immediately can provide a crucial upfront tax benefit. It reduces your early-stage taxable income, which is often exactly when cash flow might be tightest. It's about getting a jump start on your deductions, which can make a real difference in those vulnerable initial years of operation. Don't leave these easy wins on the table. Make sure you or your advisor makes that election properly.
Speaking of significant deductions, let's definitely talk about a relatively new but incredibly powerful one. It's been a true game changer for many flow-through entities. The Section 199A Qualified Business Income, or QBI, deduction. Can you give us the overview?
The QBI deduction, yes, absolutely a game changer since it came in with the Tax Cuts and Jobs Act of 2017. In simple terms, it allows eligible business owners to deduct up to 20% of their qualified business income. This is potentially a substantial reduction in their overall taxable income, designed really to provide a comparable benefit for pass-through businesses relative to the lower corporate tax rate.
Okay, 20% of QBI. Who's eligible? How does it work for partners and LLC members?
In terms of eligibility, this deduction is generally available on the ordinary business income that flows through directly from a partnership or an LLC to the individual partner or member via that Schedule K-1. It's designed to provide a tax benefit to owners of these pass-through businesses. However, there are definitely some important nuances and limitations. For instance, as we just discussed, guaranteed payments for services typically don't count towards QBI. Neither does investment income like dividends or interest that flows through. Also, for higher income taxpayers, there are complex limitations that can kick in. These are based on the amount of W-2 wages paid by the business and also the unadjusted basis immediately after acquisition, or UBIA, of qualified property the business owns.
W-2 wages and property basis.
Yeah.
Okay, sounds complicated for higher earners.
It can be, yes. These limitations were put in place basically to ensure the deduction benefits a broad range of businesses, but it's also tied somewhat to actual business investment and job creation, especially for those with higher incomes or in certain service professions like law, accounting, or health. Those specified service trades or businesses or SSTBs face even stricter income phase-outs for the deduction.
So complexity aside for a moment, what's the big tax-saving insight here? Beyond just the 20% number, what does it truly mean for a business owner's bottom line?
The primary tax-saving insight is that this is a below-the-line deduction. What that means is it reduces your taxable income after your adjusted gross income, or AGI, has already been calculated. For eligible partners, this 20% deduction can significantly reduce their overall federal tax liability, effectively lowering their effective tax rate by a substantial margin, maybe turning a 32% marginal rate into something effectively closer to 25 or 26% on that business income. It's a key lever to ensure your pass-through structure remains highly tax competitive, especially when you compare it to a C Corp after the corporate tax reforms. It's a direct hit on your taxable income, putting more money back in your pocket. But, and this is really important, because of those income thresholds and the W-2 wage and UBIA limitations for higher earners, strategic planning is often essential. You need to understand how your business income, your W-2 wages paid out, and your asset base interact to maximize this deduction if you're near or above those thresholds. It's not just a passive benefit you get automatically, it's an active planning opportunity.
That brings us perfectly to our next section. Let's move from the theory and the rules to reality by looking at some common errors. We're going to walk through what are called tax diagnostics. These are flags, basically, from a tax preparation software report highlighting potential issues. These aren't just minor errors that trip up software. They often represent missed opportunities for correct tax treatment and therefore potential savings that directly impact your bottom line. Or they represent compliance risks.
Indeed. These diagnostic messages are often fantastic learning tools. They flag areas where the tax code is nuanced and getting it right can save a lot of money or avoid future headaches with the IRS. Let's look at issue 1. Misclassified net rental real estate income. The error described here was that $35,000 of net rental real estate income was incorrectly included in the ordinary business income calculation on page 1 of Form 1065. The diagnostic correctly points out it should have been entered as a separately stated item on Schedule K and then flowed through on the K-1s that way.
So what's the real impact of making this mistake? It seems like just moving a number from one line to another on the form is really a big deal.
Oh, it's far more than just moving a number around. The corrective action is straightforward, yes. Move that $35,000 from the ordinary income calculation to Schedule K as a separately stated item. But the tax-saving insight, or maybe tax compliance insight, is absolutely critical here. Proper separate statement is not just about neatness. It's about applying the right rules, particularly those passive activity loss rules we mentioned earlier. Rental income and losses are often subject to these specific rules, which have their own deduction limitations at the partner level. If this $35,000 was actually a loss instead of income, misclassifying it as ordinary business loss could allow a partner to incorrectly deduct it immediately against other income, when maybe it should have been suspended under the passive activity rules because they weren't actively involved. This means you might incorrectly take losses in the current year that should be carried forward, leading to an underpayment of tax and potential audit risk. Conversely, if it's income, like in this example, incorrectly classifying it might mess up how future passive losses from other activities get absorbed. It's a common mistake with real consequences for your tax bill and future tax planning. It could prevent current year deductions or alter how future income is taxed. It has to be right.
Okay, definitely more than just moving a number. Next up, issue 2, salaries versus guaranteed payments. This diagnostic flagged that payments to partners totaling $50,000 were mistakenly entered as salaries and wages on Form 1065, line 9 or 10, instead of as guaranteed payments to partners on line 10. And crucially, the diagnostic notes that no entry was made for these payments on Schedule K or the individual partners' K-1s where guaranteed payments should appear. What's the consequence here?
Yes, this is a classic misstep, happens all the time. Payments to partners for services are not salaries. They are generally guaranteed payments or distributions. The corrective action is clear. Reclassify that $50,000 from salaries and wages to guaranteed payments to partners on Form 1065, line 10, and then, critically, ensure it's properly reported on Schedule K, line 4, and flowed through to line 4 of the Schedule K-1 for each specific partner who received them. Now, the tax-saving insight here, or again, maybe the tax accuracy insight, even though both salaries and guaranteed payments are typically deductions for the partnership, their impact on the partner Schedule K-1 is very different, particularly concerning the calculation of qualified business income, QBI, and self-employment income. Remember, guaranteed payments for services are generally excluded from QBI.
Right, we covered that.
While the partner's share of ordinary business income typically does qualify. If these payments are misclassified as salaries and therefore may be implicitly treated incorrectly later in the QBI calculation, it can lead to errors. It could cause the partner to miscalculate their QBI deduction, perhaps overstating it and facing penalties later. It also ensures the income is correctly subjected to self-employment tax for the partner, which is vital for Social Security and Medicare purposes. It's a precise distinction with a measurable dollar impact on the partner's tax liability and compliance.
Okay, precision matters. Finally, we have issue 3, blank self-employment earnings for active partners. Here, the diagnostic noted that the line for self-employment earnings, that's Schedule K-1, line 14, Code A, was left blank for both partners. This was despite the fact that the boxes were checked, indicating they both actively participate in the business operations they are general partners or materially participating LLC members. This feels like a significant oversight.
It is indeed a very common and potentially very costly oversight for the partners. The corrective action is simple on the software side. The tax preparer needs to remove whatever input or code was used to incorrectly leave that line blank. For active partners, general partners, or LLC members who materially participate both their share of ordinary business income or loss and any guaranteed payments they receive for services should generally be included in their net earnings from self-employment reported on that K-1 line 14A. The tax-saving insight here isn't about saving tax directly, but about accurate tax compliance, and avoiding potentially severe underpayment penalties. Self-employment tax, which covers Social Security and Medicare, is a significant chunk for many partners. It's often around 15.3% on the first significant portion of earnings, and then 2.9% on earnings above that threshold. Ensuring this line is correctly populated means accurately calculating your self-employment tax obligations on your personal return. If it's understated because this K-1 line is wrong, you could face substantial underpayment penalties from the IRS, plus interest. It also means you might not be getting proper credit for Social Security and Medicare benefits down the road. If it's somehow overstated, well, you might be overpaying SE tax. Accuracy here is paramount for both compliance and ensuring your future benefits. These diagnostic examples really hammer home how specific details, if missed, can lead to substantial financial implications for individual partners.
Absolutely, details matter. All right, now let's talk about something that acts like your personal bank account within the partnership, a crucial financial guardrail, as you called it earlier. It determines how much loss you can deduct and sometimes how much cash you can take out tax-free, your partner's tax basis. What exactly is it? How is it different from just looking at my capital account on the partnership's books?
Okay, partner's tax basis. It's essentially your personal investment in the partnership for tax purposes. Think of it exactly like that, your financial guardrail. It's crucial because, as you said, it dictates two main things. First, how much loss you can deduct from the partnership on your personal return each year. And second, how much of the distribution you can receive from the partnership without triggering an immediate taxable event, like capital gains. The formula is key, and it's where many people get confused or just look at the wrong number. Your tax basis includes your capital account, which reflects your contributions minus distributions, plus your share of income and minus your share of losses, plus your share of partnership debt or liabilities. This last part, the inclusion of liabilities in basis, is often overlooked but is incredibly important. It's what differentiates your tax basis from simply your capital account shown on the balance sheet, or even on some lines of the K-1.
Okay, so the pass key here is that distinction. Capital account is more like your book equity, but tax basis specifically includes your share of the partnership's liabilities. I like that bank account analogy. Income increases your account balance basis, and withdrawals, distributions decrease it. But what's the ultimate importance of this bank account in practical terms for a business owner? Why track it so carefully?
The ultimate importance, the number one reason, is this. Your basis limits how much loss you can deduct from the partnership on your personal tax return in any given year. If your share of the partnership's losses for a year exceeds your calculated tax basis at the end of that year, before considering the loss, you simply cannot deduct those excess losses in the current year. They become suspended, meaning you can't use them yet to offset other income. This is a major missed opportunity for current tax savings, especially if the business is going through a tough patch or investing heavily.
Okay, suspended losses, that sounds bad. So how does this bank account, this basis, adjust annually? What specifically increases it and what decreases it? What should partners be paying close attention to?
Right. Your basis isn't static. It adjusts constantly, reflecting the financial ebb and flow of your investment and the partnership's activities. Your basis increases from several key items. First, any additional cash or property you contribute to the partnership during the year. Direct investment boosts basis. Second, your allocated share of partnership income and gains. This includes both ordinary business income and those separately stated income gain items like capital gains or dividend income we discussed. Taxable income flowing to you increases your investment stake. And third, and this is a huge one for partners, especially general partners and active LLC members, increases in your share of partnership debt.
Increases in debt boost my basis. How does that work?
Yes, it seems counterintuitive sometimes, but the idea is that if the partnership takes on more debt, you as a partner, especially if you're personally liable or it's qualified non-recourse debt, are considered to have effectively increased your amount at risk or invested in the partnership. So if the partnership takes out a new loan, your share of that loan increase immediately boosts your basis. This can be incredibly important for allowing you to deduct losses or take distributions tax-free.
Okay, contributions, income, debt increases make basis go up. What makes it go down?
Conversely, your basis decreases due to a few things. First, cash or property distributions you receive from the partnership. When you take assets out, your investment basis logically goes down. Second, your allocated share of partnership losses and deductions. This includes ordinary business losses and also separately stated loss deduction items like that Section 179 deduction or charitable contributions. These represent a reduction in partnership capital attributable to you. And third, decreases in your share of partnership debt. If the partnership pays down a loan, Your share of that debt reduction will decrease your basis, reflecting a reduction in your amount at risk. Understanding these adjustments is vital. If you're planning a large distribution, for instance, you absolutely need to know if your basis is sufficient beforehand to avoid triggering unexpected taxable gains. Similarly, if you anticipate the business having large losses, you need to ensure your basis is high enough before year-end to actually be able to deduct them currently.
This sounds like something you really need to track carefully year after year. Let's walk through an example to really solidify this. We have Rick Jones, a 50% partner in Acme General Partnership. At the beginning in year one, Rick contributed $50,000 cash. The partnership's total debt was $20,000 at the beginning of year one and increased to $25,000 by the end of year one. So debt went up by $5,000. During year one, Acme Partnership had ordinary business income of $140,000, dividend income of $8,000 separately stated, a Section 179 deduction of $30,000 separately stated, and made charitable contributions of $16,000 also separately stated. Rick also received $18,000 in cash distributions during the year and a guaranteed payment of $15,000, though the guaranteed payment itself doesn't directly impact basis calculation beyond being income. Okay, quite a few moving parts. How do we calculate Rick's year one ending tax basis? What's the step-by-step?
Okay, great example with lots of pieces. Let's break this down step by step for Rick's tax basis. First, we need Rick's 50% share of all the relevant partnership items reported on the K-1. His share of ordinary business income is 50% of $140,000, which is $70,000. His share of the separately stated dividend income is 50% of $8,000, giving us $4,000. His share of the separately stated Section 179 deduction is 50% of $30,000, which is $15,000. And his share of the separately stated charitable contributions is 50% of $16,000, which is $8,000. We also need a share of the change in partnership debt. The debt increased by $5,000, $25K and $20 stores. So Rick's 50% share of that increase is $2,500.
Okay, got all the pieces. Now how do we build the basis?
Right. Let's build up Rick's basis calculation, starting with his initial investment at the beginning of year one. We begin with his initial cash contribution, $50,000. That's the foundation. Then we add his share of initial partnership debt at the start of the year. The debt was $20,000, so Rick's 50% share is $10,000. This is critical. His starting basis isn't just his cash, it includes his share of the business's opening debt. So Rick's initial year one basis in partnership interest is $50,000 plus $10,000 equals $60,000.
Okay, starting basis is $60,000. Now apply the year one activity.
Exactly. Now we make the adjustments for everything that happened during year one. Remember, the order matters slightly, usually increases first, then decreases like distributions, then other deductions losses. First, the increase in share of partnership debt. The debt went up by $5,000 overall, so Rick's 50% share of that increase is $2,500. This adds to his basis. So $60,000 plus $2,500 plus $62,500. Next, add his share of ordinary business income, $70,000. Basis goes up. $62,500 plus $70,000, $132,500. Then add his separately stated dividend income, $4,000. Basis increases again. $132,500 plus $4,000, $118,500. Okay, now the decreases. First, subtract the cash distributions he received, $18,000. Basis goes down. $136,500, $18,000, $118,500. Now subtract his separately stated charitable contributions, $8,000. This also decreases basis. $103,500, $8,000. $8,000, $95,500.
So after all that, Rick's year one ending tax basis in his partnership interest comes out to $95,500.
That's correct. $95,500 is his ending basis. Notice the guaranteed payment he received, $15,000, didn't factor directly into the basis calculation itself. It's income to him, reported separately, but doesn't increase or decrease basis in the same way these other items do.
That's incredibly clear how each item fits in. You have the positive stuff like income and debt increases, and subtract the negative stuff like distributions and deductions losses, effectively maintaining this running balance of your investment for tax purposes. And understanding this running balance, this $95,500 number for Rick, is paramount for strategic tax planning, isn't it?
You're absolutely right. The powerful insight here is that proactively managing and understanding your basis is paramount. It's not just a bookkeeping exercise. If Rick's basis had been, say, only $10,000 before considering his share of a potential $50,000 loss, he could only deduct $10,000 of that loss this year. The rest gets suspended. Knowing exactly how factors like partnership debt increase your basis provides a strategic lever. Maybe you plan contributions differently, or maybe the timing of debt financing matters. It's about being proactive so you don't leave potential deductions or tax-free distribution capacity on the table. You need to know your basis number. And that leads us directly to the next critical concept, the tax basis limitation itself. This is precisely why you can't always deduct all your losses, and more importantly, what you can potentially do about it. The hard rule is straightforward, as we've touched on. A loss allocated to you from the partnership can only be flowed through and deducted on your individual tax return to the extent of your calculated tax basis in your partnership interest at the end of the year, determined before the loss. It's a non-negotiable ceiling.
So what happens to those excess losses? The part of the loss that's bigger than your basis, they don't just vanish into thin air, right? You said they're suspended, like they're waiting in limbo.
Exactly. They don't disappear, thankfully. When your allocated losses exceed your basis, that excess amount is suspended. This means you can't deduct them this year, which, as I said, can feel like a punch to the gut, especially if you needed that deduction. But the good news is these suspended losses are not lost forever yet. They can be carried forward indefinitely to future years. They just sit there, patiently waiting in the suspended loss account, waiting for your basis to increase in a subsequent year so they can be released and deducted then. The catch, however, is a big one, and you have to be aware of it. If you end up selling or otherwise disposing of your entire partnership interest before you're able to generate enough basis to use up those suspended losses, they are lost forever at that point. Poof.
Ouch. Lost forever. That's a motivation advantage basis. So if you have suspended losses sitting there, the clear goal is to reinstate your basis, right? To get it high enough in a future year to unlock those losses. What are the key strategies for a partner to do that? How do you make sure those valuable loss deductions don't eventually vanish?
Right. The strategies for reinstating your basis are essentially the flip side of what increases it annually, but now we're looking at them from a proactive planning perspective, specifically to absorb those suspended losses. The key ways include: 1. Generating future partnership income. As the business becomes profitable again, your share of that ordinary business income or separately stated income gains will naturally increase your basis, potentially freeing up prior suspended losses. 2. Making additional capital contributions to the partnership. This is often the most direct way for a partner to inject funds and immediately increase their basis. If you have suspended losses, contributing more capital can create basis to deduct them now. 3. And again, that important one, increases in your share of partnership debt. Strategically timing partnership borrowing or even restructuring existing debt can sometimes increase a partner's share of liabilities included in basis. This is often a very accessible and powerful way for active partners or LLC members to boost basis specifically to absorb current or suspended losses.
So careful planning around contributions or debt might be needed if you see losses coming or have suspended ones.
Absolutely. The compelling tax-saving insight here is simply, don't let valuable losses go unused and potentially disappear. Understanding how the basis limitation works is step 1, but more importantly, understanding how you can strategically increase your basis, especially through planning additional capital contributions or managing the timing and structure of partnership debt, can ensure you get the full benefit of your business's tax losses when you most need them. It's about being proactive, so you don't leave those potential very real deductions trapped in limbo and eventually lost forever. This is a critical area for ongoing tax planning, especially for businesses in growth phases or cyclical industries.
All right, let's wrap up our deep dive today by talking about the structure itself for many businesses, LLCs, limited liability companies. We know they offer limited personal liability, which is huge, but you called them the flexible chameleon of business taxation earlier. Beyond just the liability shield, what makes them so unique and such a popular choice, especially for new businesses?
Yeah, you hit on the core non-tax benefit already. LLC members, the owners, enjoy limited personal liability for the business's obligations. This is a massive protection similar to what corporate shareholders get. It means your personal assets, your house, your savings are generally shielded if the business gets sued or can't pay its debts. This is a key differentiator from, say, a general partnership where the general partners face unlimited personal liability, or even a limited partnership where there's still at least one general partner on the hook personally. So protection plus flexibility.
Okay, liability shield is key, but what about the tax side? You said they're flexible chameleons.
Right. The true genius of the LLC from a tax perspective lies in their unparalleled tax classification choices. The IRS doesn't actually have specific LLC tax rules written in stone in the same way it does for partnerships or corporations. Instead, LLCs are incredibly flexible. They get to choose how they want to be treated for federal income tax purposes. This is where that chameleon analogy really comes in. They can effectively blend into different tax environments based on what's best for them.
So what are these choices? How does an LLC decide how it wants to be taxed?
It depends on the number of owners, primarily, and whether they make an election. For an LLC with at least 2 owners, a multi-member LLC, the default federal income tax treatment is automatically as a partnership. This means everything we've just spent this whole time discussing, flow-through taxation, Form 1065, Schedule K-1, guaranteed payments, basis rules, the QBI deduction all applies directly. This default is often chosen for its single level of taxation and relative operational simplicity. However, that same multi-member LLC can also elect to be taxed as a C corporation by filing Form 8832 or an S corporation by filing Form 2553 if eligible. They might do this if the corporate structure offers specific benefits for their unique situation, maybe for attracting certain types of investors, specific fringe benefits, or different ways of handling retained earnings.
Okay, so a multi-member defaults to partnership but can elect corporate status. What about a single-owner LLC?
For a single-member LLC, the default treatment is even simpler. It's considered a disregarded entity for federal income tax purposes. This means the LLC itself isn't seen as separate from its owner for tax. If an individual owns it, the LLC's income and expenses are simply reported directly on their personal tax return, usually on Schedule C of Form 1040, just like a sole proprietorship. There's no separate entity return like a 1065 or 1120 needed at the federal level. Super simple. If the single-member LLC is owned by, say, a C corporation, then its income and expenses are just included directly in the owner corporation's tax return. Again, disregarded as a separate entity.
And can they elect out of being disregarded? Can a single-member LLC choose to be taxed like a corporation?
Exactly. Any LLC, even a single-member one, can elect to be taxed as either a C corporation using Form 8832, or, if it meets the S Corp requirements, an S corporation using Form 2553. An S Corp election for an active single-member LLC is actually quite common as a strategy to potentially save on self-employment taxes once the business reaches a certain profit level, but that involves taking a reasonable salary, which adds complexity.
Wow, okay. That is incredibly flexible.
It really is. So the core tax-saving insight, or maybe strategic insight for LLCs, is precisely this flexibility. It allows business owners to choose the tax classification that best suits their current financial situation, their growth trajectory, their exit strategy, and their long-term goals. Whether it's the utter simplicity of a disregarded entity, the well-understood single taxation of a partnership, the default for multi-member, or the potential planning opportunities and complexities of an S Corp or C Corp structure. This choice of tax classification is a foundational tax planning decision that every LLC owner should carefully consider with their tax advisor, ideally right at the outset when forming the business, but it can sometimes be changed later too. It's not just about liability protection, it's about strategically aligning your business structure with your tax strategy from day one.
Fantastic. We've really taken a deep dive today into the sometimes twisty labyrinth of partnership and LLC taxation. We've uncovered not just how income flows through and how different expenses and items are treated, but also the critical proactive role of concepts like guaranteed payments and especially meticulous tax basis management. These aren't just dry tax rules you read in a book. They're the powerful levers that, if you understand them and apply them correctly, can significantly impact your bottom line and genuinely keep more of your hard-earned money in your pocket.
Yeah, I agree. What truly stands out from this deep dive for me is that tax efficiency in these structures isn't just about filing the right forms correctly on time or just avoiding penalties, although that's important too. It's really about proactive understanding and planning. It's knowing how guaranteed payments reduce partnership income, but also how their QBI treatment impacts the partners differently. It's about leveraging those immediate initial cost deductions to get a stronger financial start. It's capitalizing on that powerful 20% QBI deduction where possible for substantial tax savings. And it's absolutely about meticulously managing your tax basis year after year to ensure all eligible losses are actually utilized and not left suspended or worse, lost forever. Each detail we discussed today is a potential pathway, maybe a hidden key sometimes, to keeping more of your hard-earned money and optimizing your business's financial health over the long run.
So as you, our listener, reflect on your own business or perhaps future ventures you're planning, here's a final thought. Ask yourself, what seemingly small detail in your current or planned business structure, maybe it's how partners are compensated, how costs are classified, how debt is structured, or just tracking that basis number could, with just a bit more focused attention and proactive planning, unlock a significant tax advantage you didn't even know existed. The deep dive into your own financial setup, maybe spurred by some of the things we talked about today, might just be your next great move towards true tax efficiency and building more wealth.